So it's a great pleasure to be here and welcome you all here today as chair of the Bretton Woods Committee. Thank you. We have a great panel today to focus on harnessing innovation, both financial innovation and artificial intelligence innovation for economic growth. I have four very distinguished panelists to help us explore those issues. I'm going to start with the official people, Klaas, who's the president of the Netherlands Central Bank. He's been president for quite some time, even though you're much, much younger than I am. And he's head of the Financial Stability Board, which plays a very important role in digital finance space. Next to Klaas, Hester Peirce, who's a commissioner of the SEC, and she's chair of the SEC's Crypto Task Force. Next to me, Dante Disparte, who's the Chief Strategy Officer, Head of Global Policy and Operations at Circle. And at the far end, my colleague, and we've worked a lot together on BWC papers, Siddharth Tiwari, who's a senior advisor to India as India's taking on the G20 presidency, and he's a vice president at the International Finance Forum. So I'm going to plunge right in, ask the first question. So this is a very broad one. What financial innovations do you think have the greatest potential to enhance productivity and increase inclusion? So why don't I start with you and we'll just go down the line.
All right. Well, first of all, it is an honor to be on the stage with such an august group and great to share a stage with you again, Bill. So there's one piece of the puzzle which is, I think, fair to ask in this environment. We're living in a global economy where we have to do more with less. I think that's the broad value proposition that we're all contending with. And so technology and innovation for the sake of it is not the answer. The answer, and I think so many people have asked this of my industry, digital assets and crypto, is why are we doing this in the first place? And I've always tried to anchor the way I've approached it and the way we've approached this at Circle from the lens of we're trying to complete unfinished work, either in the payment system or in the banking system. And so that to me is often the best framing. If your financial needs took bank holidays, then there was no reason to innovate around banking and payments. But the fact is, you and I can't wait necessarily for fast payments. And so if you were looking at just the architecture of moving money around the world, around and outside of the walled garden environments, then we need infrastructure that could actually reach people in a device-centric way. So that's always one of the starting points. And so therein, it's hard to ignore the benefits of open blockchain infrastructure, for example, as a common ledger. Financial services shareware would be one good way to describe it, as a common ledger that enables this activity to at least have the common ledger be the medium of exchange or the rails. The second piece of technology is obviously mobile wallet infrastructure. If you were designing M-Pesa for the 21st century, you would probably turn to open financial infrastructure at the wallet level, because in the end, that is also the end point for the activity itself. And then the last piece of the puzzle, in some ways, is cryptography is the long form of the term crypto. Unfortunately, the term crypto is evocative in the minds of its opponents and proponents of very opposite ends of the spectrum. But if you use the long form, cryptography, it's the same technology that allows these flights that we take to have redundant systems and to have the presumption of privacy, for example, in our financial lives. I think those are very powerful core technologies that over time, we're definancializing the technology itself and starting to see it for what it is, general purpose infrastructure that incumbent institutions and startups alike can use to go places where money could not go if it just stayed analog.
So I'm going to beg off a little bit in the sense that I'm a regulator, not a technologist, so it's a little bit hard for me to identify those trends ahead of time. But I will say one thing I find promising is technologies that can disintermediate, that can take away the big central intermediaries and allow people to engage in peer-to-peer transactions that can lead to a more resilient financial system. And it can also lead to an elimination of barriers to entry that may have existed in the past for certain people. It makes it easier for everyone to participate in the financial system on the same terms. So that's something I'm excited about.
Well, Hester said it very well. As a regulator, of course, it's not our role to pick the winners here in the industry. What our motto in dealing with digital innovation has always been that we want to try to harness the benefits while mitigating the risk. And these are two sides of the same coin, as far as we are concerned. Obviously, digital innovation has a lot of promise when it comes to increased efficiencies, better tailored customer propositions, also better possibilities for financial inclusion. But at the same time, if you think about the other side of the coin, the risks, many of the risks are actually not all that different from the traditional risks that we see in the financial system: credit and liquidity risks, operational risks, governance risks. They just manifest themselves in a different way than traditional financial products do. But our role is really to be as technology neutral as possible. So we try to put in place the safeguards or the guardrails, however you want to name it. And within these guardrails, obviously, there should be room for financial innovation. And then it's for those in the industry to decide what will be the winners within these restrictions.
Okay, so I'm going to take a different angle on this. Global growth this morning got revised down to 2.8%. And for the next 30, 40 years, 3/4 is going to come from middle, low-income countries, and largely from Asia. So the question is, what kind of technology is useful for keeping growth up in Asia? Excluding China, there's a demographic dividend. The median age is 28. So you can join the dots that technology is really important. And in Asia, digital public infrastructure powered by AI will be the single most important driver of growth, of increase in productivity in the next 10 to 15 years, and the single vehicle to scale it up, to go from 1 to 1 billion in 2 to 3 years. And so many of you are thinking, oh, he's pushing in the area of getting the state involved and all that. Absolutely not. Digital public infrastructure started in the US. Internet and GPS are two prime examples that the Department of Defense gave us. And the private sector built on that. So the estimates are that increase in growth is anywhere from 5 to 10%. These are large numbers. In Asia, Estonia is 2% a year that they've been able to get. The work done at BIS earlier said that not only does it allow you to leapfrog, meaning that India, through its digital public infrastructure, was able to do in the financial sector in 8 years, where traditional processes would have taken 50 years to do. But importantly, it targets the marginalized groups. And those are the groups that get left behind in the traditional development model. So if you look at the Indian story, the marginalized groups, men and women, rich and poor, high school education, without education, employed, unemployed, the gaps went from high teens to low single digits. And so that's the push that is needed in Asia to get there. The risks are obvious, and we can talk about it a bit later. But that's, I think, a single major push.
I think the financial inclusion is also a potential huge benefit, and that's particularly important in low-income countries. I mean, Africa, for example, could benefit enormously by having a digital infrastructure because the continent is pretty broken up into a lot of different countries. There's not a lot of trade between African countries with each other. And so you can certainly imagine a system that allows for more savings, more capital deepening, more investment. And so it's not just about the financial instruments, what the macroeconomic consequence of having that is. I'm going to turn to a much more narrow subject now, which is stablecoins. I'm going to turn to Klaas and Dante on this. So stablecoins, the Financial Stability Board has laid out some regulatory principles for how responsible innovation would look like for stablecoins and digital assets. So I'd like you to assess, like, from your perspective, Klaas, how do things stand? Do you feel like enough progress has been made in sort of spelling out what good looks like? And if we do get the appropriate regulatory regime, what kind of benefits do you think that would unlock? So Klaas first, and then Dante.
Okay, well, first, let's take a step back. I think it was in 2023 when we came out with two sets of recommendations, actually one for crypto assets and crypto markets, and one for global stablecoin arrangements. And one of the reasons why we felt that the time was ripe to come forward with these recommendations was that we saw that the potential for systemic risk in the crypto space became larger, in the sense that not only did the sector itself grow larger, but also the interconnectedness with the traditional financial system became more manifest, taking on leverage, for instance, which is always something that we are very watchful of at the Financial Stability Board. And so we came forward with two sets of recommendations, also because we fundamentally believed that these were two different types of animals. And when it comes to stablecoins, obviously one important difference with other crypto assets, if I may use that term, is that there is this stabilization mechanism. There are rules around redemptions, and there is typically a slightly different governance surrounding the stablecoin. So we came up with these requirements in 2023. They are, of course, recommendations. We don't issue regulations, we issue recommendations. And it was crystal clear, and it continues to be crystal clear, that these recommendations can only be successful if there is some form of global implementation. Because if there is one business that is cross-border, nowadays you can take a server under your arm and put it in any jurisdiction and start issuing digital assets if you want to do so. So these recommendations set a sort of minimum standard. They are not very prescriptive, and they are meant to be not very prescriptive, in the sense that we do believe that jurisdictions have their own specificities and should therefore also have the space to implement. But as I already said, they can only be effective if there is global implementation. Now, implementation is, I think, variable. Some jurisdictions are a bit farther progressed than others. We will have an implementation review that we will carry out this year to take stock of where we exactly are in implementation. But it's clear that stablecoins, they warrant our attention, because compared to other crypto assets, they fulfill potentially more roles, more money-like roles, as a means of payment, also as a store of value. They have a higher pretense, already in the name stablecoin. I think there is stability in there is money in there, which I think sits aside from other crypto assets. So we will have to watch how far progressed our individual members are with respect to implementation. But it is crystal clear that we need global implementation, and we need also global cooperation, information exchange, etc.
I think it's fair to say the U.S. has probably lagged behind, and that's sort of important given that most stable coins are actually denominated in dollars.
Well, recommendation number one is actually that there is clarity about which regulator is responsible for what part, and I believe that this is currently being filled out in the U.S., right? I mean,
finally, right?
Well, that's your word.
Dante.
Yeah. Well, first of all, it's probably useful for the audience to define what it is and why it is. So, if you think about the vast majority of the world's payment systems innovations are really messaging innovations, instructing which balance sheet to debit and credit. And along comes the stablecoin, which Klaas and others are right in having looked at it with skepticism over the last many years. In the global regulatory conversations, I partly feel to blame for with a small stealth mode startup called Libra. That never launched, but nonetheless really catalyzed a lot of the global regulatory reactions to it. But why it's a breakthrough in payments is because for the first time we now have an asset that can achieve settlement finality the moment the sender and the receiver send it to each other. And so therein lies, frankly, I think it's the purpose, the why do these things exist in the first place. They were also trying to solve, quote, crypto's original sin, which was buyers and spenders remorse. That if Bitcoin were to emerge and the Bitcoin blockchain was to emerge as a payment system or electronic money on the internet, its mathematical scarcity created a problem. And that problem was that the second you went and bought a bunch of pizza with your Bitcoin and you realized the next day you bought $80,000 worth of pizza for yourself and your 15 friends, wasn't a great use of what is today being akin to digital gold. But at the same time, any stablecoin issuer that ignored the pre-existence of electronic money rules, state-based oversight, and here in the United States of money transmission and payment activities, did so at their own peril. And so you had quite a lot of examples of stable and name-only coins like Terra Luna, which famously blew up over the course of a weekend, and many others. And so the category now lives, frankly, if you're a stablecoin issuer and you choose to be unregulated, it's because you chose to be unregulated. Even here in the United States, we have two pieces of legislation that advance that. Our model is laissez-faire. If you're going to do nothing, at least do no harm. And it's not surprising that the dollar is the reigning currency in the age of the internet. But it would be helpful to actually have federal rules so that companies like mine don't face the rest of the world and have dollars more regulated in Europe or elsewhere around the world than we have here in the United States. But that's the whole function of this activity. And I think Sir John Cunliffe, formerly with the Bank of England, said, the firms that survive these, quote, crypto winters and blowups may very well be the Amazons of the future. And I think part of what we all should push for is that future is much more distributed. Ajay Banga said recently at the Economic Club that people are everywhere, but opportunity is not evenly distributed. For the first time, these technologies actually allow us to envision a much more competitive and participatory financial system than the one we have today. And I think for that alone, we ought to encourage the innovation from an opportunity-based lens rather than a risk-based lens.
Thank you. I'm going to ask Commissioner Peirce about a comment she made 5 years ago. She said that dealing with the SEC on crypto assets was like a regulatory version of an escape room. I've never been in an escape room, but apparently it's like you're looking for clues to try to solve some sort of problem, and apparently very difficult to get out of the escape room. So I'm curious, Commissioner Peirce, as chair of the SEC Crypto Task Force, how are you going to resolve this escape room problem?
Well, I hope more successfully than I did when I was in an actual escape room where I did not manage to get out without help from the Deus Ex Machina. So this time we're trying to make the clues a little bit easier. And what we're trying to do is essentially identify areas where things are not within our jurisdiction. So speaking of stablecoins, the staff put out a statement recently saying, stablecoins that meet these criteria are not within the securities realm, and I think that's helpful for people to know. And then we're trying to identify things that are within our jurisdiction, and with things within our jurisdiction, we're trying to work to provide guidance around disclosure, and then also guidance around registration in a way that's achieves the objectives of the SEC, but is also commercially feasible. And so I think that we can get there with some interim steps of providing guidance, and then we're working toward longer steps of regulatory clarity, and then of course working with Congress as they're working on legislation. And I think that that method will be very helpful. We're trying to get a lot of input from people. We're having roundtables. We have one coming up on Friday. We're meeting with lots of people, getting written input, and I think trying to do this in a way that makes sure we're taking into account the pain points that people have, but also the need that people have for good disclosure so that they can make good decisions about whether or not to participate in this. And we've seen a lot of interest, so I think it's positive, but a lot of work.
So I'm going to ask you a follow-up question. So stablecoin, is it a commodity, is it a security, or is it money?
Well, I mean, I think
that's what some of the fight
I think our point is to say, look, it's not, if you take a stablecoin that's not paying a yield, it's not within the security category, and what we did lines up, I think, well with what Congress is working on, and so I think then it's likely that that stable coins, and I should let Dante speak to where he thinks this will end up, but I think it's likely that stable coins will end up in the prudential regulator's wheelhouse instead of the SEC's wheelhouse.
Yeah, I think it's probably right. I'm going to turn to Siddharth and contrast India and Asia with the U.S., where there's been a lot more progress made. So what is it about India and Asia more broadly that's able to make so much progress in terms of faster payments, digital finance? I mean, it stands in stark contrast to the U.S. I mean, if you look in the United States, for example, you have FedNow and CHIPS has a fast payments system, but the usage is like de minimis. And in India, it's a really important part of the financial infrastructure.
So I'm going to borrow a little bit from Bill's work that all of you should read, but embed it in the Indian structure. So I'll talk a little about the financial sector, but it's equally applicable to health, education, e-commerce across the board. So 4 points. 1, the initial conditions matter. There was no legacy system. There were no cards like the US, totally dominated by cards. There was no e-commerce. China completely dominated by Alipay and WhatsApp Pay. It's a region where there are low-ticket, high-volume transactions. And so you have to get to 1 billion really fast, otherwise it's not going to work. So what was important here, supportive policy framework. In most of these countries, the government has taken the initial step to define in broad terms what the agenda is. I think in many of these, the financial system has been the first to digitalize. So you need a supportive central bank in this setting. And if the financial system digitalizes, the best practices, like whether it's open, interoperable, and all, they cascade down to other sectors. China, US did not do that. So you had the e-commerce sector digitalize, Amazon, Tencent, and you end up with what we were talking earlier about walled gardens that are completely insulated from competition. So that's an important thing to keep in mind. Then the design principles, which are fairly clear. It needs to be open. It needs to be interoperable. One key thing in Asia, as opposed to US and Europe, is that it needs to be modular and reusable. These monolith systems that are massive, they're very expensive. Second, the upgrade in technology, it's really expensive to do it. And they don't last. In Asia, largely speaking, these systems are fintech, big tech friendly. Like if you look at the Indian payment system, Google Pay, WhatsApp Pay are riding the payment rails, and they have no problem in doing it. But it needs to settle inside the regulated sector. And so there's a good combination of regular financial sector and big tech, fintech. Needs to be AI compatible. The Indian payment system is in English. There are 24 other languages. In maybe 6 to 9 months, everyone will be able to access it in 26 languages. So that's, again, a big jump. It's today operating at 18 billion transactions a month. Do the arithmetic, it's over 200 billion a year. That's massive. Another 6 months, it will be 1 billion a day. So that's the scale up that's needed. Implementation is key. If you take this system and you globalize it, there are about 100 countries that will not be able to do it because they don't have the capacity to maintain a sophisticated technological system. So I think in the next 6 to 9 months, and this is some of the work that will come out of the Bretton Woods Committee, you will see a rapid move to a cloud-based digital public infrastructure as a service. When I look around this room, I mean, half the people are my age. So when we were working, we all had these departments in our institutions who would write the programs, and then we would have to do it. Today it's SaaS. Software is in the cloud, everyone gets it down. So that's where this is going. And that allows you to scale it up to Africa, where every country doesn't have to redo their architecture. So implementation will be a big part of this.
So do you see India, sort of selling this as an export service, as a service to other countries? Because they developed the platform, they developed the technology.
So many countries in Asia have tried it. India has tried it. China has tried it. It is very difficult to sell the identity slab of this architecture. So in this architecture, you have identity, you have payments, and then you have data. So that's sort of the three levels. Identity is very difficult to sell because they are very fearful.
Privacy issue.
Yeah. And they're fearful that it is transmitting information to India. And so in that sense, putting it in the cloud will solve it because the cloud companies are willing to give the encryption key to the country that's using it.
Interesting. I'm going to ask a question for all of you. So the paper that Siddharth mentioned was on cross-border payments, and I think we view that as a very attractive use case for this technology because cross-border payments, especially for remittances, are extraordinarily expensive, and they're actually very slow as well. So the interesting question I have is how do you, and there are some countries that have made quite a bit of progress, and there's Project Nexus that the BIS is putting in place for interlinking a number of Asian countries. But how do you take this globally? The progress has been, I sort of felt like they're on a feasible path, but the progress is quite slow. How do you get this process sped up?
Well, I'm happy to start. I mean, in some ways, it gets back to the policy message, right? We, the West, you could argue, won the actual space race when the political leadership gave us a destination. It was the John F. Kennedy moment. By the end of the decade, we'll land on the moon. But yet, unfortunately, I think so much of the technology conversation, I think Siddharth has made the right points. Tech is often the easy part. It's all of the rest of it, the entrenchment, the incumbency, the regulatory questions that are fair. But we have to move from a risk-based conversation to an opportunity-based conversation, because in some ways, the tech is, in fact, the easy part. If you take just the experience of the stablecoins, good or bad, like them or not, they're global. This is the perfect medium of exchange for Thomas Friedman's hot, flat, and crowded world. And you and I don't send cross-border emails. We send instant messages to trusted counterparties, irrespective of where they are in the world. And this innovation, as an extension of banking and payments, is in fact exactly that proxy for money and value exchange. And so it is genuinely a global phenomenon. And the question to be asked is, how do we then, instead of regulate this innovation to death, or how do we enforce this to death, how do we make it an extension of the very type of fast payment systems that the Indian continent has an advantage of, and show that it isn't just an intranet of value that you could create with these novel technologies, but that you could in fact also extend them through extranets and internets as well. And so in some ways, they're also compatible with one another, and that the more compatibility and proximity to unequivocally banking and payments and prudential activity, not commodities and securities activities, the better. The Europeans have done this, by the way. Under the markets and crypto assets framework, stablecoins are treated as an extension of electronic money rules. So the whole of the European market has a common framework with legal clarity for the end user for this product, but the product's core features, at least on that side of the market, is internet-based money that is instantly payable and receivable to trusted counterparties. And that should be an extension of fast payment systems, domestic payment systems, not in competition with them.
You guys are sort of in a little different place where you have 50 states regulating money transmitters. How do you deal with that?
Well, I mean, in some ways, I've testified in Congress, and I have been at this for a little while. If you upload the U.S. dollar onto the internet, that's your fast track to getting summoned everywhere. But I think in some respects, the US fintech constitutional crisis is a feature, not a bug. Our state oversight of payments and insurance, two really critical industries, has allowed for really novel companies to emerge, be it Stripe and Apple Pay and PayPal and many others have emerged from that regime. What we need, and the real way we will, quote, win the digital currency space race, is a federal framework that ensures that the end users of these technologies, be it stablecoins or other products in the future, have legal assurances that rival what the Europeans have done. So we're advocating for a harmonization and up-leveling of those two regimes as opposed to a race to the bottom, which sadly has defined the maiden decade of crypto, is that the innovators have been have been overwhelmed by, frankly, human failures, not technological ones. Greed, fear of missing out, and all these issues have driven more risk to the sector than the technology has.
Other comments on this? Cross-border payments?
Well, maybe,
Klaas?
I mean, of course, I wouldn't have the courage to liken the G20 to the former President Kennedy of this country. But it is true that actually the G20 already many years ago has set some very concrete targets for faster, for cheaper, for more transparent and more inclusive payments in its payments roadmap, and the FSB was asked to coordinate that roadmap among the financial regulatory community. That being said, it is true these have been translated into quantitative targets, but it is true that implementation has been uneven. So there are some payment corridors in which these targets are being met, but unfortunately there are also payments corridors where I think we're still pretty far off meeting these targets. Initially, they were intended for 2027. We have recently communicated that this is not that we will not make that deadline, at least not on a global scale. Yeah, what is crucial is that not only do we need interoperability, so the interlinking of fast payment system, but there also needs to be regulatory consistency. And of course, the types of regulation that come to mind here are particularly AML, CFT types regulation. So it is quite a challenge, like it was perhaps to set a man on the moon. It's quite a challenge to get there. It's a challenge that also requires the private and the public sector to cooperate, because at the end of the day, it's the private sector that will have to make most of these IT investments to make it happen. But I still believe we shouldn't give up, because it is really for certain parts in the world, as you said, the cost of remittances are so high. This is just bread on the table for these people. So I think it behooves us as the global community to keep putting in our efforts and to make sure that we do not only make progress in the more advanced parts of the world, but that we don't forget that there is also a less advanced part of the world for which it is even more important that we satisfy these targets that we've set ourselves.
Siddharth, any comments?
So broadly, there are two worlds there. One's digitalized and one's tokenized. In the digital world, there are maybe 70 instant payment systems. Within that, three regions, and these are big regions: United States, Europe, and China. The market penetration is minimal for fast payment system. I'm hopeful that Europe will get there, but United States and China will not. The people are very, they're very satisfied with the cards in this country, and it's not going to get there. And I don't think a fast payment system will break the monopoly of 10 cents and Alipay in China. So first, you need to go from 70 to 190. Second, you need to go deep. And BIS has this project Nexus that should be pursued. Effort needs to be expanded globally. And the reality is, it's just a matter of time, 5 years, when all of you, me, everything in this room will get tokenized, right? And when we are in that world, in the payment system, you'll be in two spaces, whether it's CBDCs or stablecoins that were talked about. And last year, Carstens and Nilekani talked about a world where everything would be tokenized, not just the financial assets, that would be tokenized, but non-financial assets like this bottle of water or a painting. And in that world, it's an amazing concept where things would move, smart contracts would be attached to these tokens, they would automatically execute. But that world is a way far out because you need harmonized standards for unified ledgers. You would need interoperability across the ledgers, a robust regulatory system. But that is the aim that one needs to have in their mind, a totally tokenized system that not just for the financial assets, but for every asset, including human beings.
We'll see if we get there during our lifetime. Commissioner Peirce, any thoughts on this?
I'll stay out of this one since it's outside my remit.
So I'm going to turn back to you. Okay, artificial intelligence. A lot of use cases, innovations happening really fast. Suggests to me that it's going to be pretty difficult to regulate it because you're always going to be sort of behind where it is. So what challenges do you think AI pose for regulation in the financial sector?
Well, I mean, I think there are challenges, there are also opportunities. I think it can be a good tool for regulators to use, of course, with proper protections so that regulators don't trample over financial privacy. But I think it can be useful. AI is not new. It's been used by the entities we regulate for a long time. And you're right that the pace of innovation is really fast now, and I think that's exciting. It can be very tempting, I think, when something like AI comes out for a regulator to say, we've got to come out with a comprehensive regulatory solution for AI. But then my question is, well, what are we solving, right? If there are problems, if the technology is creating some new issue in our space, let's look at that issue. Let's identify whether it's one that's a market failure that will be corrected, or is it something that we need to have a regulatory solution for? And if we need that kind of solution, how can we craft it in a way that allows the innovation to move forward and puts, the minimum burden on people possible? So I think actually we don't need to do anything immediately. We certainly need to be educating ourselves, talking to academics, industry folks who are using the technology, try to stay on top of things as much as possible. But really, when I look at AI and I look at humans are more complicated than AI, and we've managed to regulate them for many years now. So I'm optimistic that we can handle AI.
Klaas?
Well, yeah, just in some ways I share that optimism, but we, of course, the financial system is rife with all kinds of interconnectedness, and I think the question that we've been asking ourselves is to what extent can AI give rise to additional forms of interconnectedness or stronger forms of interconnectedness. And there is, of course, there is the potential for that, right? There is, of course, third-party dependencies, service provider concentrations are possibly there. You can have the risk of correlated trading strategies, correlated pricing. Cyber risks are also part of it. So I think there is something to watch specifically in AI over and above what we would normally already do in financial services. The question, of course, the relevant is what can you do about it? Well, first, I think looking at data gaps and information available. Is the information really available that allows us to make an assessment of these vulnerabilities? Secondly, ask yourself whether there are sufficient supervisory and regulatory capabilities to assess AI. And then to also look at our regulatory and supervisory frameworks, whether there is sort of AI can be incorporated into these frameworks or not. So it's again, I think, a different manifestation of some of the risks that we know quite well, but with a potential of intensification because the world is moving so fast and also a lot faster than in traditional forms of finance.
Let me follow up with both of you. How do the regulators stay sort of up to speed? one of the problems with all this technological innovation is the people, as they come out of Berkeley and Stanford and MIT, they go into the private sector. Typically, they don't go into the public sector. How do you get the right people in your organizations so that they can make informed judges about technology?
I mean, I think one way to do it, there are a lot of people who want to spend some amount of their career in the government, and I think it's trying to, make it clear that we welcome not only lawyers and accountants, but we welcome people who have that technical expertise. I think that's probably the best thing that we can do. And then once they get into the agency, we have to make it not frustrating for them, and I think that's not easy because when the people who know that these technologies also have identified ways that regulators can use them to make themselves more effective. And if you tell someone who comes into an agency, sorry, but we're not using any of that. Well, yeah, if they come and tell us we're doing it wrong, and we tell them you're doing it wrong and you're moving too fast and we can't let you try these tools, and then they just leave in exasperation. So we have to be careful about that. But I think it really is important to try to attract some of those people so that they can help us think through these types of problems that you raised.
How are you finding it, Klaas, in terms of?
Well, I mean, that's of course difficult. I mean, there is always the traditional division of, let's say, roles, developments, that innovation takes place within the industry. That's where the action is. And as a supervisor or a regulator, you're always one step behind, because then you observe what's going on in the industry. Then you have to start thinking, okay, what does it mean for our mandate of safety and soundness? What are the risks, and how can these risks be dealt with? So I think being a step behind of the industry has always been there. That's also healthy, because that's, again, where the innovation needs to take place. It is, in this area, is really challenging to find enough people that also want to be on the other side. But then again, there are also enough people with a more public profile, which are not all that risk-seeking themselves and are more risk-averse. That's the type of people we generally attract in the labor market, and they're also there in let's say the part of the labor market where these skills are available. But I'm not going to downplay it. It is a challenge to find qualified supervisory and regulatory staff in this area.
Dante, I'm going to ask you a question about, from the private sector's perspective, what's your vision for AI applied to the financial sector?
Yeah.
What use cases do you think are most close to actually being implemented, and how will that actually change how we do business?
I mean, for one, I would argue that, just putting on a regulatory hat for 30 seconds, we're used to one next to choke, and so we have entity-based and activity-based regulation. Where I think we have often failed, unfortunately, is in the tech neutrality test. The other test that I think we need to apply more fairly is principles will age better than prescriptions. And there's so many recent examples of very prescriptive regulations that won't fare well and won't be future-proof.
Because the setup's different.
Precisely. The other comment I would make is, in extending the regulatory discussion, is we have to go from entity and activity-based regulation to also regulating code and conduct. And by code and conduct, I mean literal code audits and the conduct and the behaviors of, be it novel assets and novel activities. But therein, too, there's exponential gains to be made for the regulators. For example, here in the United States, when the Colonial Gas Pipeline was held for ransom, and crypto, not monolithic any more than banks, was the medium of exchange for the ransomware attack, aren't we better off that we had firms that could help track, trace, and in this case, retrieve the funds? And so even in cases where the assets might be completely decentralized and distributed, we're better off because we have a public-private partnership, if you will, that tries to guard the entirety of this novel financial system and not just leave it to the shadows and the edges. And I think that's a wholesale upgrade of a lot of the infrastructure. And so I think AI is not going to take your job. Somebody who uses AI might take your job. And so, we got to start having a more pragmatic technology discussion, in which, instead of looking at the Terminator movie as the end state with AI, we look at something kind of in the middle. Glorified Clippy, maybe I'm dating myself, is in fact the place where it's probably going to land. But in our company, we have incentivized every single person in the firm to be capable and proficient with AI in the same way that they had to be once upon a time with Microsoft Excel and using the internet.
I'm going to turn to Siddharth. Everything we've been talking about has a huge data component to it. So, and to bring that up to the next generation requires significant investment and regulation. So what do you think the challenges are? And talk about the Indian situation, because they seem to be farther along than a lot of countries. What are the lessons learned? What are the challenges?
Two things here. The first is, I think most of Asia, when you look at it, it's probably true here too, but most of Asia, society is divided into three sections. The top 10% have 60% of wealth, income. The next 30% have 30% of wealth and income. And the bottom 55% have 10% of wealth and income. The bottom 55 had no access to capital because they are unable to post tangible collateral. And these are economies with low ticket, high volume transactions. So the question is, can you create information collateral that can lessen the burden on tangible collateral? And the Indian answer is yes, you can do it. To do it, you need to, what technologists call, you need to move from platforms to protocols. That's what you need to move on. Can this be done in a manner that promotes innovation and data privacy? I think the answer is yes. There is a third way to do it. To rely on the market is to lose data privacy. To rely in a system where there's heavy regulation is to lose innovation. In the Indian context, what they've done is that they've embedded the privacy protocols in the system and then let the innovators free at the back end to innovate and do what they want to do. And in that manner, it has succeeded. And I think the challenge in all of this is, I don't know about all of you, but when I download an app, it takes me less than 3 seconds to say I agree. Right? I never read the thing.
All the documentation.
And ex ante consent is broad and sweeping because you're giving your consent for things that have not happened or will happen in 20 years. So that's one. The second one is that data is usually stored in incompatible formats in different silos. You don't have access to it. So in India, they've started a data exchange system where all the GDPR laws and rules are embedded into the act. The point of departure is that the privacy protocols are built into the system. So if you use the system, you're complying with the privacy protocols. It's fairly new. But it's a big country, 1.5 billion people. So if you do something in million, doesn't matter. So it's about 9 months old. There are 150 million consumers that have signed on. About 95% of the banking system has signed on. And to date, data-based lending is somewhere around 200 million or so. It's still low by country standards, but I think this is an example where you could reach out to the bottom part of the population that has been pushed out of the system. But you do need to be able to embed these protocols into the system.
We only have a few minutes left, so I'm going to turn to Dante and ask a question. What can the international institutions, BIS, FSB, World Bank, IMF, do to support the development of these technologies and their implementation? And then get Commissioner Peirce, President Klaas, not to respond.
Yeah. Well, I have to be very careful because I don't want to be declared non grata. But I think it's time for us to shift the debate to watch what they do, not what they say. If you think about the countries that have permissioned in these activities and these technologies, the whole of Europe has done it. The United States will eventually do it. Many countries in Asia have done it. The future's already here, it's just not evenly distributed. And I really think it's important that the international institutions move from a risk-based discussion to an opportunity-based discussion. And for the first time ever in human history, the very technologies that Siddharth just described are accessible to anyone, anywhere. And that's why, in many respects, this technology wave is a correction on the misdeeds of big tech and the misdeeds of a technology model that dominated single postal codes as opposed to were more broadly distributed. And so I think there's a big opportunity there. Now, of course, technology alone is not a panacea for the world's problems, but it often shows us where we're falling short. And all of these issues, we're falling short.
Do you think the official institutions are too risk-averse in this
100%. 100%. In part
I
because,
thought you might say that.
in part because, in fairness, the public institutions are answerable to the citizen for the failure of these things when they fail. And that's why I do think if you're going to get this model to work, you can create accountability to entities, whether you're a token issuer or a stablecoin issuer. You ought to have a universal accountability for that product functioning everywhere, irrespective of the technology on which it rides. We've got to push for outcomes as opposed to policy paralysis.
So from your perspective, Commissioner Peirce, what does good look like from the SEC's perspective?
Well, I mean, I think it is to no, go ahead.
Compare and contrast what you hope things will be over the next 4 years in contrast to the last 4 years.
Yeah, I mean, I think it is to recognize the fact that it does sometimes take more courage to allow things to allow innovators to innovate. I mean, it really should, that should be the expectation that people will be able to get products and services out there that meet a market need. And it can be very easy to become extremely risk averse and to forget that there's a cost when you say no also. I think you do have to, you can't forget the risks, but you have to remember that there's a real opportunity cost if you say no always to innovation. And I do think that international bodies of regulators, you put a bunch of regulators in a room together and they all get each other all fired up about all the risks, and they forget to think about the opportunities. And again, it's not to say that there aren't risks. We can all learn from each other, and I think we should be talking about those risks that cross borders, but we should be remembering that we're serving no one if we just try to use the regulatory system to cut innovation off before it blossoms.
Klaas, I'm going to give you the last word.
Yeah, no, that would also not clearly be the description of how I would see our mandate. No, I think we try to be technologically neutral, so we approach new developments from the principle same activity, same risk, same regulation. And by translating that into recommendations or a global regulatory framework, what we try to provide is, of course, regulatory certainty. We try to provide what are the parameters within which innovation can actually flourish, and these benefits can also be harnessed. So that is one thing that I think we produce. And the second thing is international cooperation. Because, again, these are global products, global developments, so you want to have something of a level playing field. You want to make sure that the playing field is equal in different parts of the world. And you want to also limit the potential for, let's say, cross-border spillovers. That lax regulation in one part of the world creates a lot of damage in another part of the world, because that is not good for our mutual atmosphere, I can assure you, if these things happen.
It's a good plug for the Bretton Woods Committee, International Cooperation and Coordination. Thank you. Thank you all.